Market structure in smart money. Why is it needed and how to work with it? What role does market structure play in trading? Which elements should be taken into account and which ones can be ignored? Let us understand this question. In this video we will consider 1. The main mistakes that 80% of beginners make when analyzing market structure. 2. How to correctly determine the market structure on the chart. 3. What is really a structural element and what is not. 4. Why large capital does not focus on the market structure in its transactions. What indicators will help to correctly determine the market structure. We'll talk about that too. But before we start, subscribe to the channel and like the video. This helps to quickly release new training videos. Let us start with market structure. In trading, it is the alternation of highs and lows on the chart, which helps traders to visually determine the current state of the market and try to predict its future movement. In the smart money concept, the market structure is very similar to the classical approach, but here additional concepts such as order flow and multi-structure complex correction are added. It is important to note at once, big capital does not trade according to the structure, its algorithms create it themselves. When you gain more experience and learn to observe charts, you will notice that the key elements of the structure are formed by filling imbalances and liquidating significant liquidity zones. In essence, market structure is not the cause, but a consequence of the algorithms of big capital. We, as retail traders, can only analyze these traces on the chart and make assumptions about what actions smart capital has taken in the past and what it may do in the future. However, even a competent market structure analysis does not provide a 100% guarantee in predicting price. Its main purpose is to increase the probability of your setup working out successfully. Let us talk about the basics of market structure. Let us not go into details yet and start with the basics. There are 3 market states. Uptrend. The price of the asset is moving up. Downtrend. The price is going down, sideways. There is no pronounced trend and the market moves in a narrow range. At first glance, everything is simple. If the highs and lows are rise going down, it is a downtrend. But this is only in theory. In real market conditions, the situation is much more complicated, especially for novice traders. The most important thing is to learn how to correctly identify significant maximums and minimums, because not all points on the chart are really important for analysis. Let us look at a schematic example. Such extrema on the chart are called swings. Swings are key structural elements that represent pronounced peaks and troughs. However, not all of them should be considered when analyzing the market structure. There are 2 types of swings, 3 candle swings and 5 candle swings. I use only 5 candlestick swings and recommend my students to do the same. This allows you to significantly reduce market noise and get a cleaner picture of price movement. But there is an important question: how to identify a 5 candlestick swing and not get confused. How to understand what to mark on the chart and what to ignore. After all, the slightest mistake in analyzing the structure can lead to a wrong choice of direction, which will completely devalue the further analysis of the situation. 5 candlestick swing is formed as follows. In the center is 1 candle that forms an extremum. On either side of it there are 2 candles that are either above for the minimum or below for the maximum. It is important to remember, if you draw the structure by eye or are guided by intuition, it is a huge mistake. Incorrect definition of the structure can lead to erroneous analysis and, consequently, to opening a deal in the wrong direction. The result is a stop loss and missed opportunities. Therefore, to prevent this from happening, TradingView has many indicators that help analyze the market structure. One of them shows 5 candlestick swings on the chart. Here is how to enable it. In TradingView, go to the Indicators section and type Wick. Add fractals in the search bar, add it to your favorites, and install it on all your charts. Go to the settings of this indicator and in the Arguments tab you must set the value 5. After that, the indicator will automatically display all 5 candlestick swings on the chart. The indicator initially has color settings for the dark theme in TradingView. Therefore, if you have a light theme, you should change the color settings in the Style tab to make the indicator visible on the chart. It does not always work correctly, but for beginners it will be the best start to see 5 candlestick swings on the chart. But the good news is that over time, you will learn to understand the logic of smart money. You will clearly distinguish between where there is a trend reversal and where there is a normal correction, where is the main structure and where is the internal movement, where is a false break in the structure and where is a true break in the structure. So, in this introductory lesson, we have broken down what is the market structure of a smart money market, what elements form the structure, swings, how to set up an indicator to display 5 candlestick swings and use it to build the structure,